Hi, in this video, we'll look at the differences between the holding corporation structure and the family trust structure, so you can decide which structure is more applicable to you. Hi, if you're new here, my name is Sam Cao. I am a Canadian CPA. I used to work as a tax manager at one of the big four accounting firms, and now I run my own tax practice and I teach accountants and bookkeepers how to prepare corporate tax returns so they can start their own practice. And as always, these videos are for educational purposes only. Don't take it as advice. Always talk to your lawyers, advisors, and accountants before you implement any tax strategies. So before we begin, let's talk about the goals we want to achieve and see whether either structure meets them. So the first goal is the ability to claim the lifetime capital gains exemption when we sell the business. The second goal is to minimize taxes when we sell our business. The third goal is the ability to transfer our business to our children at the lowest tax possible. The fourth goal is the ability to separate active business and investment business for liability protection. The fifth goal is we'll take a look at which structure is easier and more affordable to set up and maintain. And then the last one is which structure can last for a long time. So those are the goals we will keep in mind as we review each option. So what is a holding corporation and how to set up? A holding corporation is just another Canadian-controlled private corporation that owns shares in another Canadian-controlled private corporation with an active business. It's not a special type of corporation, it's the same one as the active business corporation. You can turn active corporation into a holding corporation, and you can turn holding corporation into an active corporation. So let's take a look at this. Let's say this is your current structure. So you as an individual shareholder, you own shares in an active corporation. And you own 100 common shares with a adjusted cost base of $100 and then the fair market value of $1 million. How can you set up a holding corporation? Well, the first step would be to set up a holding corporation here. And then you will subscribe for the common shares. 100 common shares, ACB is $100, and then fair market value is also $100 because this company doesn't have anything other than $100 for the common shares. So then the next step is you want to sell the shares in active business corporation to the holding corporation. So you transfer the shares to the holding corporation. But when you do that, you will have a capital gain because you just sold something for $1 million with a adjusted cost base of $100. So you have a capital gain of $999,900. But to avoid that capital gain, you can file a Section 85 rollover. And when you file this Section 85 rollover, it allows you to transfer the shares not at a fair market value, but at cost at $100. And as consideration, the holding corporation will issue you preferred shares. So in addition to 100 common shares, you now will also own, let's say, 1,000 preferred shares with adjusted cost base of $100. So that's what we paid. And then the redemption value of $1 million. So that's it. So now you own 100 common shares in a holding corporation and 1,000 preferred shares in the holding corporation with a redemption value of $1 million. And then the holding corporation owns 100 common shares in the active business corporation with a fair market value of $1 million and an adjusted cost base of $100. So that's how you go from just having a regular active business corporation into this structure where you have a holding corporation and an active business corporation. Okay, so what is a family trust? A family trust is a legal arrangement between three parties: settlor, trustees, and beneficiaries. So when you set up a family trust, you have a settlor. So let's say a friend, and the settlor puts $100 into the trust. And then there are trustees. Let's say it's you, spouse, in lawyer. So the trustees have authority to control the family trust. They can decide what to do with the assets of the family trust, so what to do with this $100. And then they can decide how to distribute the assets of the family trust to the beneficiaries, or how to allocate income and capital gains to the beneficiaries. And then you have beneficiaries. So beneficiaries are the ones who are entitled to the income or capital of the trust. So it could be you, your spouse, your children, grandchildren. You can name anybody as a beneficiary. So beneficiaries don't have a say in a family trust. Trustees have a say, but you can be a trustees and beneficiaries as well if it's set up properly. Okay, so that's a family trust. So how can we go from this structure, 100 common shares, ECP is $100, and fair market value is $1 million. Okay, how can we transfer this business to the family trust? And let's just put this as you. Well, unfortunately, we can't sell our shares to the family trust and do the Section 85 rollover just because the family trust doesn't have money to pay for it. And plus, rollover doesn't work on family trust like that. So the only way we can do that is what we will do is we can exchange our shares for the preferred shares, which we can use Section 85 as well. And what we will do is instead of 100 common shares, now we own, let's say, 100 preferred shares, or 1,000, doesn't matter, with the adjusted cost base of $100. And then instead of a fair market value, it's a redemption value of $1 million. So why do we do this? Well, if we own common shares, the common shares have this ability to change in value. It can grow in value or it can reduce in value. By exchanging to preferred shares, we are fixing the value, meaning that it will stay at $1 million. And then, let's change this to this. And then the family trust can use this $100 to subscribe for new common shares. 100 common shares, adjusted cost base is $100, and fair market value is also $100. So when we first set up this structure, the value of the common shares that are owned by the family trust is nominal. But as the business grows, let's say grows to $1.5 million, you will still own $1 million worth of shares, but then that $500,000 is now allocated to the family trust. So the future growth is allocated to family trust and therefore can be allocated to the beneficiaries. Another thing that we usually set up here is a wealth corporation. Or holding corporation. It doesn't matter how you call it. But this corporation is a corporate beneficiary of the trust as well. And we'll talk about how we can use that later. But that's how you set up a holding corporation, and this is how you can set up a family trust structure. One thing I will also add, let's move it here. You will also own these shares when you set it up. So let's say 100 common shares, ACB is $100, and fair market value is $100. A little bit of a spider web here. Okay, so let's take a look at the first goal, the ability to claim the lifetime capital gains exemption. So what is a lifetime capital gains exemption? It's one of the tax benefits that we have as a Canadians is that when we sell qualified small business corporation shares, we can claim this exemption. And this exemption allows us to essentially pay zero tax on the first $1.25 million of capital gains. So let's just put it here. Lifetime capital gains exemption equals zero tax on $1.25 million of capital gains. But in order to claim this exemption, we need to meet several tests. The first one is 90% of the assets have to be used in active business at the time of the sale. I'll make another video to go more detailed about this exemption, but this is just a high-level overview. So it just means that right before the sale, we want to make sure that 90% of the assets have to be used in active business. If we have too much redundant assets, such as investments in this corporation, that can put us offside. But to fix this, it's not hard to fix this problem. All we need to do is we can just pay a dividend to ourselves right before the sale so that our assets used in active business is more than 90%, or at least 90%. So even though it is easy to fix, it is costly because when you pay a dividend to yourself, you have to pay tax on that. The second test is 50% of the assets have to be used in active business for the past 24 months. So it's a very similar test like the first one, but instead of 90%, they look at 50%. And instead of at the time of the sale, we look for the last 24 months. So this is harder to fix. It's not something that you can just pay a dividend. You have to look back for the last 24 months and to be certain that at least 50% of the assets were used in active business. So that's why if you plan to sell your business, make sure you tell your accountant or your lawyer at least 2 years in advance so they can make sure that you meet this test so you can claim the lifetime capital gains exemption. So the second test is obviously harder to meet. And then the last test is you have to hold the shares for 24 months. So this test is also easy to meet. Essentially, you just can't set up a corporation and then sell it within 24 months. You have to wait at least 24 months before you sell this business. Okay, so let's apply this to our structures. When we have a holding corporation here, what we typically want to do is we want to pay a dividend to the holding corporation. So that way, let's put intercompany dividend. So then we use the money here to either to invest in stocks, bonds, real estate, cryptocurrency, and then pay a little bit dividend to ourselves to maintain our lifestyle. But there's a lot of investments in the holding corporation. So if you have a lot of investments here, it is still possible to meet this test. It's just you have to distribute the dividends to yourself. Again, that becomes very costly because now you have a large dividend to yourself. You have to pay huge personal tax on the dividends. And then you will have a capital gains on the sale of the company. And now you're in the highest tax bracket, which is not ideal. And you can't have the holding corporation sell the active business corporation and claim the lifetime capital gains exemption. The only individual shareholders can claim the lifetime capital gains exemption. Same thing with this test number 2. It's very hard to meet when you have this structure. So in conclusion, this structure is good to hold investments, but it's not really built to claim the lifetime capital gains exemption. Not to mention that if you have another active business corporation here, what if you want to sell this corporation, but you don't want to sell this corporation? In order to claim the lifetime capital gains exemption, you need to sell the holding corporation, which holds both. So it creates a lot of issues down the line. So if your goal is to claim the lifetime capital gains exemption when you sell your business, maybe this is not a good structure to have. As opposed to the family trust structure. So when you have a family trust structure, you have an active business corporation that generates active business income. And that active business corporation can pay a dividend to the family trust. But this family trust can either accept the dividend and pay tax on that, which is a horrible decision most of the time, but it can also pass that dividend to the wealth corporation. So you have money moving from active business corporation to the family trust and then to the wealth/holding corporation. So this corporation is always clean, has minimal cash in there. It only has enough cash to support its active business, and the rest it just pays to the wealth/holding corporation. So when the time comes to sell this business, it's very easy to meet this test because this corporation only have assets used in active business. So we meet the 90% and 50% test. And as long as beneficiaries hold the shares for more than 24 months, they can claim the lifetime capital gains exemption. So for this goal, the winner is the family trust. The second goal is our ability to multiply the lifetime capital gains exemption. So what do I mean by that? Well, when you have this structure where you have an individual shareholder owning shares, only shareholders can claim the lifetime capital gains exemption. And it's not easy to introduce new shareholders in the corporation. So let's say if you just run this business and you are the only one who holds the shares, you are limited to $1.25 million of the exemption. But when you have this structure and you name your spouse, your children, and grandchildren as the beneficiaries, let's say there are 4 of you, you could potentially multiply the lifetime capital gains exemption by the number of the beneficiaries. So you, your spouse, your children, they all can claim the lifetime capital gains exemption. So let's say there are 4 beneficiaries in this trust. That means $5 million in exemption. They don't need to own the shares directly. They're just the beneficiaries of the trust. So this becomes super powerful because on $1.25 million of capital gains, you can save between $300,000 to $400,000 in taxes. So if there are 4 beneficiaries here, you can save between $1.2 to $1.6 million in taxes, which is huge. So for this goal, the winner is also the family trust. The third goal is our ability to transfer the structure or the business to our children. So when you have this structure holding corporation, the only way for you to transfer this business to your children is you have to sell it to them or gift it to them. Either way, it will be deemed to be done at a fair market value and you will have to pay taxes. Now, the second option is you can do the freeze just like we did here, where you exchange the common shares for the preferred shares, and then your children will subscribe for the new common shares. But then only the future growth will be allocated to your children, whereas the existing value still belongs to you. So you haven't actually transferred the business. You transferred the control and the future growth, but not the actual value. Whereas with the family trust structure, the family trust owns the shares in the active business corporation, and the family trust can pass the shares to beneficiaries essentially at cost. So let's say the family trust owns 100 common shares with an adjusted cost base of $100, and let's say the fair market value at this time will be $2 million. The family trust can transfer these common shares to your children at $100, tax-free. And then they will own 100 common shares with adjusted cost base of $100 and fair market value of $2 million. So with this structure, it is much easier to transfer to your children. Also, not to mention is you don't have to decide how many shares you will give to your children when you set up this structure. When you distribute the shares, trustees have a power to decide how many shares will go to each beneficiary. So let's say you have one child who is very involved in the business and you want to give the child 50% of the business. You can do that at that time. You don't have to decide now when you set up a structure. Whereas here, if you want to introduce your children to this structure early, you have to decide at that time how many percent of the company they will own. So with this structure, you can set up now and decide later. Whereas with this structure, you have to set up now and decide now how many shares each of your children will own. So because of that, the winner is the family trust. The ability to separate active and investment business. So when you have a holding corporation, as we discussed earlier, the active business corporation will generate active business income. You will pay corporate tax on that. And then the retained earnings can be distributed to the holding corporation as an intercompany dividend. And this intercompany dividend will not be subject to tax most of the time. And then the holding corporation can pay a dividend to individual shareholder, so they can pay for personal expenses. And the rest, the holding corporation can use that money to invest. You can invest in stocks, bonds, GICs, cryptocurrency, rental properties, although I do recommend setting up a separate corporation for a rental property, or you can just hold cash. So you have a separation of active business and investment business. And it's really good just because if this active business corporation gets sued, at least your investments are somewhat protected because it is in a separate legal entity. But the same concept applies here. You have an active business corporation, you can pay a dividend through a family trust to the wealth corporation, and then the wealth corporation hold investments. So it has the same advantages as this structure. So because of that, it's a tie. In terms of whether it's easier to set up and what's the cost to maintain, to set up a holding corporation, you just need to set up a holding corporation and then sell the shares and file the Section 85 rollover. It's not that expensive compared to other corporate reorganizations. So you're looking to spend about $5,000 to set everything up. Whereas with this structure, especially if this active business corporation has a lot of value, you need to potentially hire a third-party evaluator to come in to assess the value of this business. And if it's a private corporation, which it is, it's usually not easy to determine the price. Then you need to set up a family trust and set up a holding corporation or wealth corporation. So that can cost you between $5,000 to $10,000. And then you need to hire an accountant who understands the structure, knows how to file a trust return for the family trust, which will cost money. And not every accountant knows how to file a trust return for a family trust. So then now you have to hire a bigger accounting firm or somebody who specializes in it, which will cost more money. Whereas with this structure, you only have two corporations. Most accountants know how to file tax returns for corporations. So you will have more options when it comes to choosing an accountant. So this one is easier to set up, more affordable to set up, and more affordable to maintain. And because of that, the winner is a holding corporation. And the last one we'll take a look at is longevity. So a holding corporation, as with any other corporations, they can exist forever. So even when the individual shareholder passes away, the shares will be transferred to the estate or to the beneficiaries, but the holding corporation and the active business corporation will continue to exist. So there'll be no interruption. Whereas with a family trust has a 21-year anniversary, meaning that after 21 years, any assets owned by the family trust will be deemed to be disposed of at a fair market value. So what does it mean? It means that after 21 years, let's say the family trust owns the shares with a just cost base of $100, and then the fair market value of $2 million, the family trust will have to pay tax on that unrealized capital gain. And it's unfortunate because the family trust doesn't have money. So there are two things you can do. One, the family trust will just distribute the shares to the beneficiaries, or two, family trust will sell the shares to a third party. In any case, you will have to dissolve this structure if you don't want to pay taxes. Sometimes you do want to pay taxes, but most of the time you don't. So there's a time limit here. You don't want to set this up too early, but you also don't want to set up too late. Whereas this structure, there's no deadline, there's no limit. You can set up anytime you want. And because of that, the winner is a holding corporation. So in conclusion, both structures have their place. One isn't always better than the other. Sometimes you can't have the trust. Sometimes you only need a holding corporation. Now, hopefully you have a better idea what each structure can achieve, so you can discuss with your advisors and decide what works for you. If you enjoyed this content, please follow and comment below with your questions. And if you're an accountant or bookkeeper and you want to learn how to prepare corporate tax returns, check out my Corporate Tax Accelerator. The link is in my bio and in the description below. See you next time.